Okay, let's get straight to it. Most people don't fail in the stock market because they picked the wrong stock. They fail because they picked too few stocks. When you're new to investing, it's really tempting to buy one quote-unquote great growth stock and hope it carries your whole portfolio. See, if you only own one or two companies, you're tying your entire investment to a handful of business decisions. And that's a lot of risk most beginners don't realize they're taking. Here's what I learned. The stock doesn't even have to be bad for that strategy to fail. One company can miss earnings, a CEO can leave, a product launch can flop, and all of a sudden your entire portfolio is down and your whole day is ruined. That's not because you're bad at investing or that you're investing in bad companies. It's because single stocks carry single company risk. This is where ETFs change everything. When you buy an ETF or exchange traded fund, you're not betting on one company. You're buying a system of companies. If one company struggles, others can pick up the slack. That's diversification, and it's one of the most powerful tools investors have. Take something like the S&P 500 or the NASDAQ. ETFs that follow these particular indexes have historically been incredibly strong long term. With one ETF, you instantly own hundreds of the strongest companies in the US. You don't need to guess who the winner will be because you own all of them. These indexes have survived recessions, crashes, tech bubbles, and still grew long term. This is why you'll have a lot of investors that put the bulk of their investment into ETFs like SPY or QQQ. SPY follows the S&P 500, and the QQQ follows the NASDAQ. And then there's thematic ETFs, funds that follow specific sectors like AI, robotics, clean energy, or infrastructure. Instead of trying to pick one stock from any specific sector, you own the entire trend. For example, if you believe robotics are the future, instead of betting on a single company, you can invest in an ETF that holds multiple leaders in that space. Well-run funds spread risk across dozens of companies. Some companies will fail, sure, that's expected, but the theme can still win. See, ETFs tend to outperform people, not necessarily stocks. They help you stay invested, and staying invested is what actually grows wealth. This doesn't mean that single stocks are bad. It just means that ETFs make it harder to mess up when you're still learning. And that matters more than picking the perfect stock. Now, you know I'm not a financial advisor and this isn't advice, but if your goal is long-term wealth, then ETFs might be your best bet. ETFs let you grow with the market instead of fighting it. Make sure to subscribe for more beginner-friendly stock content like this.